Today it's my pleasure to have Professor Joshua Ronan from New York University presenting the paper Do Financial Statements Inform of Banks' Resilience? Evidence from EBA Stress Test, co-author with Amedeo Pugliese from University of Padova and Pompeo Fabra, and Trang Dao from University of Padova. So before we start, we have 5 minutes uninterrupted for the presenter. Please mute yourself. And when you want to ask a question, please unmute yourself. You can show the videos and state your institution so now we know who is talking. And then at the end, we'll have 5 minutes uninterrupted for the presenter. So Joshua, the floor is yours.
Well, Lumit, actually, I will be presenting.
You are presenting?
Yes,
Okay.
I will be presenting, and have Josh
Taking the
commenting whenever he wants. Well, Ayung and Stephen, thanks for the invitation, and Lumita, thanks for the intro. So I'm gonna have the first 5 minutes for myself, right? Uninterrupted. Great.
Yes.
So, well, we give away the answer to our question. Do financial statements inform of bank resilience? Well, the answer is yes, according to our findings. And why and how? Well, we argue that...
I'm sorry, just an interruption. Amedeo, are you putting on the slides?
Yes.
I don't see it. Does anyone see it?
Yeah, yes, it's on my screen.
I do.
It's not on my screen. I don't know why. Anyway, doesn't matter. I guess I'll skip it.
Press your share screen button.
No, it says this will stop other screen sharing. So I don't know. Never mind. Go ahead. I don't see the screen. I don't.
Joshua, I think you have the slides anyhow. So perhaps
yeah, I have the slides. That's fine. Yes.
All right. So I was saying we believe that one opportunity for bank regulators and supervisory body is relying on what we call fair value margin, which is a cushion in the way we define it, which is basically the difference between the fair value of assets from the books and from the notes minus liabilities at fair value scaled by the book value of equity. And the reason why we say this is because regulators are primarily interested in what they call a bank loss absorption capacity, which is in essence the bank resilience, or otherwise the ability of a bank to withstand potential economic crisis. So, well, stress testing has been out there for a while. It started at least 10 years ago after the GFC. And actually, through the stress testing, regulators aim at ensuring systemic financial stability. So, stress testing has this dual flavor. It's somehow micro, but it tends to speak to macro when you take it up to the systemic element of it. Now, the stress testing has had noticeable consequences. And here, the references are to Europe. So if you look at what happened between 2010 and 2014, so with 3 different stress tests, well, we've had more than 120 banks being under stress tests, of which and 51 times banks did not pass the stress test. And the ECB and the European Banking Authority, altogether found out that there was a capital shortfall in terms of equity of approximately 55 billion. I mean, that makes a clear point. I mean, this is a very relevant issue. And it also triggers a number of actions on the side, both of the regulator and the bank, because banks had to replenish equity capital, starting deleveraging. And also one of the most dire consequences was constraining dividend distribution. When it comes down to the mechanics of stress testing, and this is a point I would like to emphasize more later, stress test looks at bank resilience. And in essence, the 2 key issues are defining capital adequacy, which is related to equity as a function of asset riskiness, and also assessing distance from capital adequacy. And that's the whole purpose of stress testing. It has been subject, and it is currently subject to heavy criticism. First of all, it's very, very expensive exercise. It runs for many months, very time consuming. I believe that from our perspective as accountants, the main criticism is that we don't really understand where these risk weights and these haircuts come from. They seem to be a little bit obscure. And as Haldane put it, it seems that this simulation of adverse scenarios are sort of a black box. So our research question is very, very simple. I guess the paper is quite straightforward. Can financial statements help regulators in their assessment of bank resilience? Now, the idea we put forward is the following. Fair values provide valuable information in assessing bank resilience because it speaks to both liquidity and risk, and it's a readily available measure. So we don't necessarily need to have these very cumbersome stress testing procedure. Our main metric is fair value margin. As I said before, is fair value of assets minus liabilities at book value, scaled by book value of equity. And this is very conservative measure because in essence, what we're saying is what is the cushion, what is the leftover once the bank has served all the liabilities. We put forward two hypotheses. The first one is we test whether fair value margin is able to predict the stress test outcomes. The stress test outcome is basically a capital shortfall, meaning the distance from the prudent capital given the riskiness of assets. And secondly, we ask whether we test whether the fair value margin is also able to predict future bank performance measured as credit losses. And the reason is quite self-evident. I mean, loans and credits represent more than about 60% of assets. Therefore, being able to anticipate the losses on credits is a major issue also for the banking regulators. We test our predictions on a set of European banks subject to stress testing in 2014. And the findings are, first, we find that fair value margin is able to predict capital shortfall or capital surplus under an adverse scenario, so which is the most extreme one. And in essence, what we find is that the larger the value of the fair value margin, the higher the buffer identified by EBA. And we find that in a further specification, we find that this is particularly true for listed banks. Secondly, we find that fair value margin predicts future net charge-off. And the fair value margin, so the metric we put forward, outperforms stress test outcomes in predicting both 1 year or 2 years ahead net charge-off for the banks that are passing the stress test. Now, this is that doesn't work as well for banks that failed to pass the stress test. And we conjecture and find that banks failing to pass the stress test had to take actions. So they started selling off a lot of the loans and started deleveraging. And therefore, we find that actually they experienced negative income on the sell-off of loans and less NCOs. So we conjecture, and that's what we find. And I'm done in the, yes.
Just we have a question from Steve.
Yes.
Amedeo,
Yes.
some would say, I think our finance colleagues would say the fair value of the assets minus the liability relative to book value is the price relative to book value. Okay. So the question is, why would you look at price relative to book value instead of, or as well as the accountant's fair value of the assets? I think there's reasons why you might not do that, but it's a good competitor. There's work in finance that says that price actually helped predict the damage to banks during the financial crisis by Charlie Calamares, I think, Calamares at Columbia. So that's my
Yes.
question. Why not look at price relative to book value as the basic information?
Yes, Steve, thanks for the question. I mean, there is work that is looking exactly at what you're saying. Like, I think this is leaning more towards the S-risk measure. What we would argue is that market prices would incorporate expected growth on top of the actual fair value. So what we're looking at are exit values, in fact. So what you would fetch if you sold the assets. So market price is first and foremost highly volatile. And this is one of the reasons why the banking regulators are so reluctant in relying on market prices instead. But I mean, we elaborate on this later, but it's, it's a very good point. We actually want to differentiate from the finance colleagues.
Can I interject for just 1 second? This is not mutually exclusive. We can potentially, and we've been thinking about that, potentially use the market value of equity in addition. So we don't necessarily have one single measure. We have a set of measures that can complement each other. The problem with market values, as Amedeo suggested, is not only the volatility, but market value anticipate all future, whereas we're looking at two things: short-run stability and resilience. The long-run stability and resilience may well be helped by looking at market value of equity. So we can have short-run and long-run.
Yeah, that's right. I think that's a good perspective. I mean, it is said there are problems with fair values, the accountants' fair values, because in the financial crisis, or before the financial crisis in 2006 and 7, there was a big run up in real estate prices, which actually increased the measured fair value of the mortgage packages. Okay, and so you actually bring a bubble from the real estate into the financial statements. Maybe that bubble goes into prices too, but if the market's more observant than the accountants, perhaps the market would discount those for the bubble. The problem with fair values is that it brings bubbles into the financial statements, which can upset what you're doing here. I'm just saying this is something to keep in mind. Okay, this is sort of the downside of looking at accountants' fair values.
Well, bear in mind that it is exit values, right?
No,
also, bubbles exist also in market values of stock of equity. So, I mean, we have a common problem, right?
Yes, well, the market value, the value for a mortgage package of mortgages is the exit value is equal to the entry value, pretty much as one market price.
Right. Okay.
Yes.
Ayung has a question.
I have a question about Amedeo's kind of earlier point about using the fair value somehow kind of like it's better than the risk-weighted asset value that the regulators use, because it provides information about liquidity and risk. So liquidity, my limited understanding is that you probably need to know whether it's level 1, 2, or 3 in order to know whether there's a liquid market. So how does your test using only the dollar value, fair value from the financial statements would tell us about how liquid banks' assets are? Yeah.
Yes, I mean, this is a great point. We actually aggregate, but we could dissect the level 3, which are management's expectations. So we could definitely carve it out. I mean, this is something we looked into. Actually, it's a smaller portion of the fair values, right, in the aggregate. So, of course, if you would like to see a test excluding the level 3 because you think that they may be more noisy, we could certainly do this. So, I mean, point well taken. I think that affects our empirics.
Yeah, I think ex ante, I don't really know the hypothesis that whether the level 1, 2, or 3, which one actually will be a better predictor of future loan loss, non-performing loan losses. It sounds like level 3 is probably from assets that not traded in the liquid market or alternative assets not traded in the liquid market, but somehow reveals managers' perceived risk. And that can be a very unique information signal that is not available elsewhere in the market. So some of my colleagues, Leslie Hodders and Pep Hopkins, has been writing papers about that private information signal by the managers, actually very informative about learning about banks' risks. So ex ante, I don't think that which level of the fair value will be a superior or inferior predictor, but just that breakdown would be useful, and then comparison across fee levels would tell us more about liquidity.
That's I think I see your point now. I think it relates more to our second hypothesis when it comes down to making predictions of future potential defaults. I think it's great. It's something we certainly need to look into. And I think it very much the sign of the prediction is it boils down as to whether you believe that managers can reveal trustful information or not, right? So no, yes, noted. Thanks for the comment.
Yeah.
I'm sorry, I have a follow-up question. So for level 1 and 2, I know that the test right now is only focusing on 1 year, 2014 stress test.
Yes.
So level 1 and 2 somehow are more related to market value that Steve Penman just talked about. And it sounds that there's a kind of like very obvious business cycles, and that's leading up to 2007, prices are going up and then going down. So the question is more about the external validity. Do you think you will find the same results if the stress test is actually in 2010? Or another year? Yeah,
we did it. We have a robustness where we use 2016. Now the thing is that we find exactly the same results. The point is that we lose power because in 2016 the ECB reduced the scope of the stress testing to 15 banks, right? The other option we have is using data from the 2011 stress test, but then it's widely acknowledged that actually the test was not so reliable because there was no follow-up in terms of regulatory action. And also, and we will explain this later, the 2014 is quite important year because before the stress testing, all the banks underwent an AQR, an assessment and quality review. So basically that gives it reduces the noise in the information because every bank was actually, would undergo an inspection from the National Competent Authority and the EBA. So I think that also explains some of our results differentially vis-a-vis what others have done. So that's why we focus on this year. Now, the other point is, I mean, and I guess you're right. I mean, the fair value would be available at a quarterly basis, right? So any change it's dynamic, right? Rather than stress testing that is static. So we argue that this is one of the strength or potential strength of fair value margin because it actually incorporates the change in the distribution of value of assets that is incorporated into the price. Now, the thing is, to what extent, that this is something I'm thinking loud now, it could be that actually there is a change in the proportion of assets that are fair valued through a pricing, so level 1 and level 2 and level 3. And this could also be opportunistic, but I will surely incorporate this thinking. Thanks.
Yeah, thank you.
No more question for now. Okay.
Now, this is the next couple of slides are crucial because they help us understand what's happening with stress testing and why we argue that actually financial statements have a play. Stress testing aim at assessing, in essence, loss absorption capacity of banks, and they do it through 3 things. The first one is the estimation of risk-weighted asset. So they start from the book value of assets and they the regulator makes a series of adjustments based on the perceived risk weights, which are also somehow a little bit obscure at times. Then there is a projection, projected losses and adjustments that are depleting the regulatory equity capital. And then as a third step, they actually issue what is the required amount of equity capital to replenish prudent capital. And in essence, what you should focus your attention on is this little formula here, where we have that the capital shortfall or surplus is a function of the CET post-shock, which is therefore subject to all the losses and haircuts, and a percentage of risk-weighted asset. And this percentage is, again, very arbitrary. This is what regulators believe to be prudential capital ratio. They differ in the US and in the EU because the structure of financial statements are inherently very different. Now, to give you a further hint on what's going on with the stress testing and why we want to differentiate, have a look at the following. On the left-hand side, you've got the traditional balance sheet, and you see that, asset and liabilities plus equity balance. Then there are a series of regulatory adjustments that occur at time zero. So this is not yet the stress testing scenario. And here we apply a series of risk weights to come up with the so-called risk-weighted assets. And to give you some examples, cash doesn't carry any weight in terms of any risk weight because it's secure, right? It's already available. If a bank has past due exposures without any guarantee, then if a book value of 100 would correspond to a risk weight of 150, meaning that this is proportionally riskier than what's expressed in the book value. If instead the bank has non-publicly traded equity exposure, these are weighted 4 times the value they have in the books. And there is a clear effect on the CET1 ratio, because here there is an increased capital requirement, here there is an increased capital requirement, and here there is no effect. Similar thing happens with CET1, and I would say that this is even more complex. You start from equity at time zero from the balance sheet, and then you get to the so-called common equity tier 1, which is allegedly the highest quality of equity. And then you have to make a series of adjustments from equity to CET1, meaning that you have to take out intangibles and goodwill, you have to take out different tax assets, and so on and so forth. Now, what happens with stress testing, right? So, so let's have the example we want to give you here is what happens if there is an adverse scenario, right? And what happens is the following. Well, regulators move from book value of assets to risk-weighted asset post-scenario, and they apply risk weights that are more stringent to simulate an adverse shock, right? So if in the previous case we had a weight of 150 for the past due exposure, in the case of adverse scenario, this could go up to 250. And that means that when you want to cover with equity value these higher levels of risk-weighted asset, banks will have to replenish. So risk weights are more stringent, and this is also the basis for us to estimate prudent capital, which is the target according to the regulators' decisions. So for instance, if we were in Europe, you have risk-weighted asset of 900, you multiply it by the target prudent capital ratio, the required equity would be 49.5. Now, what happens with CET? CET is subject both to the adjustments we saw before, and also it's further reduced in its overall amount by the haircuts and other losses that actually depend on the adverse scenario simulations, because typically you would have a lot of asset losing value. So here, that's how we measure the capital shortfall or surplus. In this case, we have that current CET1 is below the expected prudent capital. In this case, banks will have to take remedial actions. Now, in going from assets to risk-weighted assets, and in going from equity to CET1 post-scenario, this is truly a black box. because we don't know how regulators come up with these risk weights. And they seem to be heavily dependent on macroeconomic factors. This is to give a further example from Deutsche Bank in 2014, and see what happens here. The total risk exposure from the actual balance sheet skyrocket after the adverse scenario simulation. And this is putting pressure on bank because they will have to increase their level of capital because of the actual risk weights and haircuts that are applied. Same thing with common equity tier 1. You see here that common equity tier 1 drops, right? This is still above the 5.5% threshold, so the bank is actually passing the test, but you can see the logic, I guess, through this example. This stress testing is subject to heavy criticism. I'm going to highlight two. The first one is this one here: risk weights and haircuts in anticipating economic shocks are obscure, so we don't know where they come from. And that's why we argue that fair values at least have some informativeness, I mean, notwithstanding the limitations that you highlighted. And the correct value of the prudent capital is still debated. I mean, currently it's 8% in the US, 5.5 in EU, but this is arbitrary. It could be 4, it could be 12, it could be higher at times of peace and lower during crisis. And this is a very expensive exercise that runs for, it involves the ECB, the EBA, the national authorities, junior teams. This is very, very expensive. So in Europe, you have about 300 people working on this. Now, there are some alternative models that are somehow competing to our. The S-RISK speaks to a point Steve was making before. Basically, the S-RISK estimates the expected amount banks need to raise in the case of a crisis to meet the prudent capital requirement. And actually, the way they do it is quite straightforward. They do it through the V Lab at NYU. They simulate a 40% drop in market equity index, and they translate it to a drop in the market value of equity of the bank through beta, right? So this is fairly standard. And they estimate the capital shortfall as the difference between the market value of equity after the shock and the 8% of what they call to be the quasi asset. Now, Steve, I really don't know whether this value of asset really speaks to a bank's ability to withstand the crisis, because first of all, it's highly volatile, and 40%. I mean, how does that translate into a drop in the value of assets, which is ultimately what regulators are chasing? There is a key innovation here. So they advance our understanding. They replaced risk-weighted asset post-shock, which is something that we find to be very obscure, with something that is transparent, because that's a market-based measure of these quasi-assets. The counter arguments for the S-RISK is that, first, this is available only for traded banks, because it relies on a shock to a 40% drop in the market equity. So it has to be a listed company. It largely overstates capital shortfall, and there is a concurrent paper by Ingyar and Shiva who find dramatic differences when they rely on S-RISK rather than financial statement-based measure of shortfall. And it anticipates growth that is unrelated to the ability to settle claims. I think that this is what we believe to be the main criticism of S-RISK. And it's totally disconnected from banks' fundamentals, right? So it's very hard to reconcile also the estimation with actually realize the risk afterwards. An alternative model to this is a C-RISK that your colleagues at Columbia are working on. This is a modified version of the S-RISK, but it's based on financial statement information to measure systemic risk. What they do is very smart because they basically split the effect of shock, and the transmission mechanism is a lot clearer here. So what they do is, during the crisis, so on the short run, liquid assets would be sold at a fire sale to settle callable liabilities. And all the impending losses that very much depend on also on the size of the losses of the sales on the market are basically depleting equity. So this is the first hit that CET1 gets. Then in the post-crisis, so once the short run is gone, they compare 8% of the leftover assets after settling all the liabilities and further reducing their value through haircuts with depleted equity. And this is basically their measure of C-risk that is fully taken from financial statements. There are two key innovations that they make here. First, they introduce the idea that commercial and investment banks, they face differential shocks of drops in the stock market. And also, they entertain a matching between callable liabilities and earmark assets. So for instance, if you're an insurance company, most likely you have liabilities you will have to pay to the insured people matched with earmarked assets. So here, the sum would be zero. This is something that is not taken into account when relying on S-risk. Some of the limitations of C-risk is, first, it relies on a 40% market drop, but this is generalized. We don't see any reason why this should be considered the adverse scenario status. It applies historically driven cuts to leftover assets once the crisis unwinds. This is what happens in the post-crisis. And this is also a very, very costly process because you have to go through each item in the balance sheet. They also look at off-balance sheet items. So this could be very costly vis-à-vis a readily available measure. And here, that's where we come with our suggestion. We argue that the bank's loss absorption capacity depends on assets available above and beyond those that are needed to pay off third-party liabilities. Now, liabilities are totally discounted from the stress testing, from the S-risk as well. So what the measure we put forward is fair value margin, as I said before. So it's assets through exit values fetched in an ordinary course of business. And then, of course, this could be affected by cycles, but that's exactly the reason why we suggest that a dynamic measure would be helpful. And liabilities in the most extreme form of a counterparty run. So this measure is very, very conservative because it's assuming that all liabilities are callable, right? The fair value margin, in the way we define it, is a cushion to absorb potential losses that may arise as a result of a crisis. We don't mimic an adverse scenario. We don't do any simulation. I'll come back on this point later on, but we do believe that this is an indication of whether the company is able to withstand on the short run a potential crisis, and also gives us this measure that is the cushion. Now, we developed two hypotheses. The first one is basically, we argue that fair value embeds both a measure of risk and liquidity. Now, whether this goes through fair value level 1, 2, or 3, I don't know whether Ayung you agree with me, but that's nearly irrelevant, right? Because for our point is, this is what regulators are aiming at assessing through the stress testing simulation. It's based either on the market or management perceived distribution of cash flow. And given that fair values are actually they follow distribution, regulators could choose a cut if they wanted to impose a more stringent condition on banks. Fair value margin is dynamics because it reflects changes in asset composition and credit profile. And we believe that it's very conservative for two reasons. One, I mentioned before, because it takes into account all the liabilities and in the hypothesis that all creditors of the firm would immediately want to run away. And secondly, we write off all the intangible assets, all the deferred tax assets that instead feature in the book value of equity. So our first hypothesis says fair value margin should be positively associated with banks' loss absorption capacity measured as capital shortfall or capital surplus. Our second hypothesis relates to the ability of fair value margin in predicting future credit losses. Now, there is literature looking into this. We find slightly different results from Cantrell and McInnes, for example, but here is our rationale. So we focus on the fair value margin ability to predict future credit losses because first, loans represent between 50 to 60% of assets in banks' balance sheet. And also because predicting future loan losses matter for future capital equity tier 1 ratios, which is the main worry for the regulators. Now, we do believe that fair values incorporate forward-looking information about credit risk, especially when loans are not credited. So if you think of corporate loans, no one else than the bank has superior information to assess the ability of the debtor to repay the loan, actually. And also, under the incurred loss model that was current at the time of the stress test, fair value of loans is more informative than book value, simply because book values would incorporate news with delay because you had to wait until losses were incurred. So our hypothesis is the fair value margin of loans has a greater predictive ability of future credit losses vis-a-vis the outcome of the stress test. How we test our predictions? First, we look at the EU 2014 stress test for some of the reasons I mentioned before. It's a superior exercise in terms of quality vis-a-vis the 2011. In 2016, the number of banks involved was less, and most importantly, there was prior to the stress test in 2013, there was the asset quality review that basically reviewed all the forced banks to review all the financial statement prompted by the European Banking Authority. So we believe that the quality of information is a lot higher.
Amedeo, we have a question from Young.
Yes.
Young.
Hi, Amedeo. I have a question about, it's more about exhibition of the paper. So previously, my question is about hypothesis 2. And after listening to your presentation, it sounds like regulators has this arbitrary in the percentage based on the risk weighted assets. And then you kind of critique about it's a black box. We don't really know what going to that 5 versus 8%. And I wonder that why do you use that black box as your dependent variable and motivate your first hypothesis? Like why do you want to find a predictor or another variable that is highly correlated with a black box that the regulator never really tells us what's going on into that percentage?
Well, I guess our argument is first, in spite of being a black box, it has had a huge impact because in determining the capital shortfall, banks had to take remedial actions. So it's something that had a huge effect. And when you tell the regulator whether you can use an alternative measure that is relatively low cost to come up with similar conclusions, because as you will see later, there is a decent predictive ability. it means that they can get to the same result, but using a lot less resources, right? What would be an alternative that you have in mind as a dependent variable instead? I mean, because clearly you're saying, can you think of a better measure of bank resilience or solvency? I'd be very happy to hear it.
So I really like the second hypothesis about the future loan losses, right? That is some economic transactions that I can foresee. For the first hypothesis, I think your answer kind of tells me there's a very important policy implication, even if it's not related to economic activities in the future, but still have a very important policy implication. That's why we should still analyze it. And my follow-up question will be, what would be the out of sample robustness or validity, right? Like for your analysis to be relevant for policy making, that it cannot be focused on only 101 banks in 1 year. So what would be the counterfactual or other alternative to kind of strengthen your first hypothesis? I think most of them is kind of more about writing and how do you position rather than running more tests, but just to make both hypotheses relevant, maybe for a different audience. Yeah.
Yes, I don't have I mean, we didn't think of this paper in these terms. What we could do is exploiting the COVID crisis and see whether that was a totally exogenous shock, to see whether we can use the fair value margin to anticipate future losses that will inevitably affect financial statements of banks in 2021 and 2022. The issue is the out of sample prediction is really difficult to find because we only have the dependent variable available for banks that have undergone stress testing, which is 2011 and 2016. In 2018, the stress testing has changed slightly. In 2020 has been put on halt. So I think we have used all the data. I mean, we could do it the same in the US, but I don't think that solves the problem you're identifying of the counterfactual, so to speak. So I don't know if Joshua and Trang have a different view on this.
No, let me just say regarding the first question that you asked is that the first step we thought about is you have stress tests that, as Amedeo mentioned, have a lot of policy implications and actions. And the point is, it's extremely expensive. Is there a substitute? Okay, so the first step was there is a substitute for the existing stress tests, however good or bad they are. So let's not worry about spending all these resources. The second is, can it perform better than stress tests in the sense of predicting useful and important measures? And in this case, we used the net charge-offs. So that's a reason we took these two hypotheses together, right? Okay, that's all I want.
Thank you.
Can I move forward, Illuminator?
Yeah, no more questions so far.
So I'm going to skip this point to get to the last one. Now, one key feature of the stress test in Europe is that it bears a very strong counter effect, because in essence, what the European Banking Authority did was simulating different adverse macro scenario test hypotheses differently for different countries. So basically what they were doing, they were comparing banks within country, right? Not across the broad spectrum. And that has an impact also in the way we basically specify our tests. So to give you an example, banks with a portfolio of loans in Spain, for instance, would be assessed or compared at the default rate of the similar portfolios held by either Spanish banks or German banks with loans to Spanish companies, right? So the comparison is really within country, so to speak. Sample and variables, I'm gonna go fast here. Our final sample is made of 101 banks from 20 countries. I mean, we lose some banks because of the missing fair value information. We take data from the EBA website in terms for our dependent variable, so the capital shortfall, and the usual for the SNL and data stream for accounting and market data. And we hand collected fair values from the nodes. Just very briefly on the variables. So the distance to adverse is the capital shortfall. So the formula is the same that we saw before. This is given by, in essence, is given by EBA. Importantly, if the distance adverse, if it's higher than 0, it means that the bank passes the stress test. That means that they have sound capital and they don't need to take any action. Whereas if this is negative, then the EBA would prompt an immediate action that could take different forms. Fair value margin, I specified it before. Then we have net charge-offs that are relevant for our second hypothesis when we test the predictive ability of the fair value margin in terms of future losses. And we do it both 1 year ahead and 2 years ahead, and then we stop, because then, you know, the longer you go, the more the effects. And there was a concurrent stress testing exercise in 2016. One last point is assets at fair value. I think this is worth 1 second of explanation. Now, some of this information is available through the book values, whereas others are only available in the notes. And these are the most relevant ones, right? The ones on the loans, held to maturity, and other assets. And here, I think, I like Jung's comments. I think here we can be a little bit more nuanced in differentiating between the different levels. Model specification. So what we do here is something that we don't see very often in accounting works. Now, for the reason I explained before, and given the nature of the stress testing exercise, in essence, what we try to do here, we are interested in understanding whether the relationship between fair value margin and capital shortfall holds both within and between countries. Now, the within country specification is basically identical to a fixed effect analysis, which in fact we provide as an additional. What we are interested also in the between countries, because we wanted to understand whether whether the relationship between fair value margin and capital shortfall for the average bank, if it exists for a given country, would be positive, right? Would be actually informative, so to speak. The coefficients of interest are beta 1, and this is the within country coefficient, and iota 1, which is the between countries coefficient. Findings. As you can see here, both in the total, as well as when we split within country and between country, you can see that there is sort of an association between the fair value margin and the distance from the threshold. Now, this becomes clearer when showing the tables. So what matters in the table you see here? This is our main predictor. The dependent variable is the capital shortfall. So that's the distance. So how far the bank was from meeting the prudent capital ratio. Now, within country, we find that fair value margin is able to predict the stress test outcomes. But this is not true for the between country estimation, right? And we speculate that actually across country, the relationship doesn't hold. I mean, it doesn't have statistical significance for two possible reasons. First, in essence, we have 20 observations here. So it could be that statistical power is missing. We could do bootstrapping. I mean, we should consider whether doing bootstrapping or not. Or it could be that this could be due to the heterogeneity in the stress test scenarios. Given that the distance from the expected prudent capital would vary in absolute terms across countries. Because as I said before, the EBA was conducting analysis, was comparing banks within the same country. So this could be another reason. Then what we do is we split it by ownership type and status. And basically we run the same test on a subsample of privately held firms or publicly held firms. And what we find is that our findings are largely driven by publicly listed firms. And here you can see that even the between country estimation gains statistical significance. So when we ask why this is the case, two possible explanations. First, well, it seems that listed companies are in a better position to measure fair value of assets because of their internal models. They can be a lot more sophisticated, and also because they are subject to higher scrutiny by the national the national listing entity. When we test the second hypothesis, the expected coefficient should be negative, meaning that the higher the fair value margin, the lower the level of net charge-off in the future, because that speaks to the fair value margin, speaks to the quality of the loans, right? And that's what we find with our metric. When we compare our metric with the results from the stress test outcomes, well, results are different. And instead, we find that the distance from the distance from the expected regulatory capital is actually positively related to future credit losses. So we need to ask why this is the case, and we do a couple of tests. First, we split the sample into banks passing the stress test and banks failing to pass the stress test, and we do it through an interaction term. And see the results here. We find that the result is still negative, and the coefficient becomes even stronger for banks that have passed the stress test, meaning these are the good ones, right? They were not required to take any action. And actually, in line with our prediction, the higher the fair value margin on the loans, so the higher the buffer, the less net charge-off would experience in the future. Whereas we find the opposite for when we use the distance from the adverse loan, which is the outcome of the stress test. And the reason why we conjecture and we do a test on this is because failed banks had to take remedial actions. In taking remedial actions, most likely they would have sold a lot of the loans at a loss, right? And this reduces the likelihood of having future losses on loans because they experience losses on the income from loans. And that's the test that we do here. We test whether the losses on disposals are higher for banks that actually fail to pass the test, and this is consistent with our finding. So I'll come back to the main takeaways. We have three types of robustness test. We don't have an out of sample prediction, as Ayun was asking. First, we use different scaling for our fair value margin measure. We now scale by book value of equity, but we get exactly the same results if we scale by total asset or fair value of assets. We use also the results from the EU 2016 stress testing. The issue here is twofold. The sample is smaller, and secondly, the EPA only worried about, the EPA removed the pass or failing criterion. So they stopped identifying banks who whose prudent capital was below the threshold. But this is something we could overcome because we applied the 5.5% threshold to the risk-weighted asset and simulate the expected prudent capital. Results hold also in this case. And then for the hypothesis 2, we broadened the window over 2 years for the future losses on NCOs, and results are still consistent. Some of the key takeaways of our work. All in all, it seems that fair value margin helps assessing a bank's loss absorption capacity, and it predicts stress test outcomes. Now, whether we like the outcomes of a stress test as a meaningful metric, I mean, we can discuss it, but this is the one that we have readily available. Our results are more pronounced for listed banks. Secondly, we find that the fair value margin of loans, so the buffer we have on the loans, so the fair value over the book value, performs better than the results from the stress test outcomes in predicting future losses. And I think that, I mean, we think that this is a relevant result because it speaks to the usefulness of fair values in the banking financials in predicting future credit losses. Now, these results are slightly different from what we have in the US setting. We speculate that the reason why the fair values in the US setting seems to be more informative is because of the AQR that was performed before the stress testing. So the AQR, the asset quality review, acted as a cleansing in the financial statements of banks before the actual stress test. Our results are consistent with expectations, meaning that banks passing the stress test had lower levels of NCOs, whereas for banks that failed to pass, had to take remedial actions, started a lot of sell-off of loans, and these actually reduced the future NCOs, but increased the losses on disposal of loans. Now, one potential concern with our measure is that we don't quantify the bank's loss absorption capacity, neither we mimic potential effects of an adverse scenario. But we do have some potential remedies to this. First of all, fair values incorporates future distribution of cash flows. So that speaks both to risk and liquidity. Therefore, all the left tail scenarios are incorporated and they change quarter by quarter. So this is dynamic. Now, regulators may want to specify a minimum threshold for the fair value margin that could be also periodically adjusted and impose banks to meet that threshold. Or they could even apply a cut to fair values and simulate and lean towards the left distribution in the fair values. That would also speak to a potential measure of a bank loss absorption capacity that is required. To conclude, we do believe that financial statements can help regulators in their supervisory role in ensuring a sound banking system. We suggest fair value margin can complement or even stress testing, or even replace it if you wish, and substitute risk-weighted assets and haircuts, which are very obscure, with fair values. Fair value margin incorporates an assessment of risk. It is available also for non-listed banks, and this is an important feature vis-à-vis the S-RISK, for example. And the forward-looking nature of fair values overcomes the classical criticism against accounting numbers that are backward-oriented. And also fair value margin is transparent, right, which is a merit, we believe. Last, fair value margin of the loans are able to predict future losses and have a higher predictive ability than than stress test outcomes. And this is partly speaking to addressing the controversy we see in the literature as to whether the fair value is really informative about future losses or not. And we argue that we find different results compared to the US companion study because of the different level of scrutiny that EU banks were subject to following the asset quality review assessment. And this is pretty much it. I hope that I'm on time.
Amedeo, I think you should mention next session as requested by Ayung.
So next session is Ray Ball from Chicago. I don't think he needs any presentation. FASB was right. Earnings beat cash flows when predicting future cash flows. And I think we will reconvene on Monday, same time. And I would like to thank Ayung and Stephen and all the people in attendance.
Any further questions before we